And I'll be sharing my screen here. Right. So good evening, everybody. Thank you very much for joining our first virtual meetup of 2024. I was getting ready to say 2023. I want to welcome everybody. Thank you very much for taking the time out this evening to connect with us. I'm looking forward to sharing some helpful information for you. If you could please mute your line, that would be great. All right. So, for those of you who don't know me, my name is Chris Price, and this evening we're going to cover the 2024 U.S. multifamily market overview and some strategies for investing. But before we get into some of those specifics, what I want to make sure that we take a little bit of time doing is just give you a little bit of information on who we are and what we're about. So, this is the Wealth Mindset and Real Estate Investing virtual meetup. The Wealth Mindset and Real Estate Investing Meetup is open to all who are interested in growing generational wealth through passive real estate investing and increasing their financial intelligence. This meetup is for the busy professionals and retirees across various industries. The individuals in the group make a good living and have discretionary income to invest in real estate for its proven wealth building power, but don't have the time, skill set, or network to do it at speed and at scale. This meetup focuses on helping us all grow our wealth mindset by leveraging how to build and preserve wealth while developing and maintaining an abundance mindset. This meetup will focus on multifamily real estate investing as well as other proven ways to build wealth through real estate investing through passive investments. And we're sponsored by Red Fox Multifamily. Red Fox Multifamily helps pharmaceutical and life science industry professionals diversify their portfolios and add passive income and get all the other perks of real estate investing without having to do any of the work themselves. Red Fox Multifamily partners with passive investors to buy commercial multifamily real estate based on vetted opportunities that we get access to from our trusted network of top operators in the best markets throughout the country. Partnering with Red Fox Multifamily makes investing in real estate completely hands off, allowing investors to add passive income and build equity and save on taxes, all while being in an investment vehicle that is backed by a hard asset. Now, in terms of the logistics for tonight, just to kind of get everyone, acclimated here. Screen is stuck. We please mute your lines when you're not speaking. You can hold your questions to the end of the presentation, but of course, if you have something that's burning, I understand. You can put it in the chat, and I'll try and address it as I go through the presentation. This presentation is being recorded. The material in this presentation does not constitute an offer or a solicitation to purchase securities, and this is for information purposes only and should not be construed as business, financial, or legal advice. Before also moving on, want to let you know that I love to connect with people. I really appreciate everyone, joining the meetup and attending and really engaging and just coming to learn. And hopefully you can go and check out our YouTube channel, for any content that you may have missed. There's a ton of topics out there, things that you can learn a whole lot from as you're informing your real estate investing journey. But I love to connect with people. Please reach out to me. You can either scan the QR code or you can shoot me an email at chris@redfoxmultifamily.com. Love to connect and just learn a little bit more about you, what you're interested in, and I'll share more about me. So what we're going to do here in a moment go. I'll just introduce myself for those of you who don't know me, and then I will take a brief moment to do go into the presentation for this evening. We'll have time for Q&A and some virtual networking if we have an opportunity to do that. And so, without further, let me just share a little bit of background about me. So my name is Chris Price, as I mentioned to you before. I am an award-winning pharmaceutical executive. I've been in the industry for over 20 years. I have in the life sciences industry for over 20 years. In addition to my work in the pharmaceutical industry, I have really been working tirelessly to help others through my real estate investing venture here, Red Fox Multifamily, which I'm the CEO and co-founder. And what we're focused on is as I mentioned before, helping and providing, professionals with hands-off commercial real estate investment opportunities that to help recession-proof their retirements. Yeah, I'm an accredited investor. I've been an entrepreneur since 2012. I've been, doing some single family, doing some now scaled into multifamily over the past few years. This meetup has been something that has been a project of mine for over, for about 3 years now, where we've been able to grow the membership to over 1,000 people, which I'm just so grateful and so grateful to be able to share information and help other people just continue to grow their wealth mindset and their real estate investing strategies. So without further, what I'm going to do is I'm going to switch over to my presentation for this evening and and go on from there. So 1 second here. All right. So you should be able to see my presentation right now. And like I said, for at Red Fox Multifamily, what we're focused on is helping people add passive income and get all the perks of real estate investing without having to do any of the work. But in order to do that, you have to really have be grounded in terms of your investment strategy on what is happening in the marketplace, what is going to make you a savvy investor, and having information, informing yourself and educating yourself is one of the key ways of doing that. This as I mentioned, this is information for information purposes only. Nothing here is considered legal or tax or business advice. Please always consult your tax or business or legal professional for advice. I shared a little bit about me again, just 20 years in corporate America. Yeah, I'm an experienced real estate investor, both active and passive. I've been a lifelong learner. Yeah, I'm really, into my fitness and I love to travel and love to cook. And I'm a proud husband and father for those of you who don't know me. But that's only a part of my journey here, and part of what I want to be able to focus on for you today is to be able to go into some specifics about what's happening in what is the outlook for the real estate market in 2024. What I intend on covering today is really a summary of the U.S. real estate market outlook. I'll look to dive deeper into specifically the multifamily market outlook, which is the area that we focus on investing in primarily. And then we'll talk a little bit about some investment strategies, where to find capital, how to access different capital to tap into deals, and then we'll wrap things up from there. But before we get into the summary of how things work and what all the information is about for 2024, I want to provide a brief background on really to set the table. So where I want to start really is if you can remember back to for the housing market crash of 2008 really created an economic recession, and many homes were foreclosed on, and the demand for housing was at a historic low. And as a result of that, many developers exited the market. And on a and at a minimum, in many cases, they delayed plans to develop. And then between the years of 2012 and 2021, there was really a lot of household formations, started by, many of the millennials, forming households. And, the U.S. Census essentially was looking at this during this time that 7 million new single family homes were built in that time. And that was short of the 12.3 million households that were formed in that almost 10-year span. And so as a result of that, what was created was really a housing shortage. And this housing shortage essentially was really a really impactful to our marketplace, because this essentially created a number where we had a significant demand for housing as a result of the increased household formation, but we did not have enough supply to meet it. And so as a result of all of that, there is clearly a need for additional housing for the foreseeable future. The demand for new affordable housing and especially apartments and growth markets is at an all-time high. And market demands such as, and growth markets such as the Sun Belt in particular, which are areas that we focus on. Think about the Carolinas, Georgia, Alabama, all the way through Texas and Arizona. These are places where that will continue to grow and to have a huge demand, but have a limited supply. So factors such as job growth, population growth, the cost of home ownership, and an inadequate, supply, and development of new construction will be key drivers for the foreseeable future in terms of that supply and demand imbalance. And so when we look at 2023, and we review what took place in 2023, I like to tell people that the story is really in single family housing. And what I mean by that, and the sources for the material that I'm going to show for you for this first portion of the presentation were pulled from Redfin. But in the research here, what you should know is that 2023 was really a difficult year for the housing market. It started with a continuation of negative trends from the end of 2022 and turned into one of the least affordable year for home buying on record. So that is substantial. And when you average over the entire year, 2023's average median sale price was higher than any previous year in history, rising up from $407,000 in 2022 to $409,000. So that is substantial for the average median sale price of homes. And so when you continue on the storyline here, what I want to point out also is that we all know, we've experienced it directly, that inflation was really had a huge impact to all of us. No one could escape it. And in fact, when it comes to rent prices, they remained historically high, but they stopped a little bit short of the record. And you can see here, according to Redfin, that the median U.S. Rent price hit almost $2,100 in 2023, and that matched the record from 2022. When it comes to inflation, the Fed was steady at trying to low inflation to their mark or their target of 2%. But it stayed around and was very stubborn, as they're saying here. The prices of goods and services rose about 6.6% year over year from February, just below that 2022 high. And so those inflation numbers are really making the cost of everything, our goods and services, substantially more expensive. It got very painful for many of us as we were looking at ways to be able to access, different things. And that, as it comes to rent prices and inflation, our ability, the rental and rent prices, our rents keep pace with inflation. And so that's something to pay attention to as we talk about this a little bit more. One of the other things that's really important to know when we talk about the impact of the single family housing market as it relates to all of this is that mortgage rates, as you all know, ballooned beyond 8% for the first time in over 20 years. And so people that bought or refinanced in 2020 and early 2023, so think about this. I'm a case study for this example. One of the folks who was, took advantage of the basement low pricing that they had for mortgages and went ahead and refinanced to levels in the 2-3% over a 30-year fixed interest rate mortgage. And for those people aren't necessarily motivated to sell their properties or to go, only to go out and buy the same property, but essentially could pay, substantially higher for it because one, the price of that home had appreciated, but also the cost of living in that same home that I refinanced from a 6% to a 3% as an example now is causing a situation where I now
Right.
want to
So
invest. I
now,
want to
looking
invest or
at that,
buy a
what
new
we just
property.
spoke about, again, this one doesn't
Excuse me.
necessarily have to have a big conversation, but I want each of you to be thinking, what contingencies should you be making from a business
Chris, you're muted.
Thank you. Sorry
Yep,
about that. I was trying to mute the background noise.
no worries.
So the situation here is that as mortgage rates had ballooned, it really caused a situation where it did not motivate sellers to sell. Home buyers didn't essentially didn't want to pay twice as much for a home essentially that they would have just a few years prior. And so the mortgage rates really had a significant impact on home prices as mortgage rates and those interest rates on homes increased, and the demand levels went up because people were staying put, and then that really put a strain on people's budgets. And when we're looking at this from the perspective of home buyers, that were looking to relocate, and some of the data that I was able to research here, what it really talked about was the migration pattern. So one of the things that I like to hone in on here is that I'm sure that many of you knows someone who relocated to the South, whether that's the South for those of you on the East Coast, whether that's the Carolinas, Tennessee, Georgia, Florida, something along those lines, or over on the out west for those of you who are familiar with that or from the Midwest, going down to Texas or going down to Arizona, Vegas, or Nevada, I should say. Those markets really were really ideal and are really ideal places for people that are looking for that sun and affordability to be able to relocate to these markets. And this is in spite of anything from a climate change perspective, wherever you sit, and with respect to that, this didn't really influence a lot of people's decisions as to whether or not they were going to relocate or not. They wanted that affordability and they wanted that change in lifestyle for them. And so many folks moved to those markets, and that is keeping pace. And from a 2023 perspective, it started with that continuation of trends from 2022, and then this again drove to making it one of the least affordable year for home buying on record. And so a lot of people took advantage of it when they could, but that created some demand as well. And as it relates, what one of the other drivers from a demand perspective that's being caused is that the housing inventory remained well below average. And so what this chart is speaking to is the fact that there was an average of, according to what Redfin, of 1 million homes listed for every month in 2023. And so in addition, mortgage rates, as I mentioned below, were the primary reasons why inventory was so sluggish. If you think about it, look, just the amount of time that homes would be on market, when, if you remember the wild and crazy days when people were, just a few years ago, when people were taking advantage of those low interest rates and the volume of homes were just turning over, and there was not enough supply to meet the demand in that case, because people would list something and it would be gone the next day. In this market, it was a bit different. People weren't listing their homes as frequently as possible because the interest rates were so high, and if they were going to be moving to somewhere else, they didn't want to overpay or feel that they were overpaying, so they stayed put, into the homes that they were having. That then lessened opportunities for those would-be home buyers, or home, whether they were new home buyers or people that are looking to buy their next home. That influenced a lot of those things. And so nearly a quarter of all homeowners had an interest rate below 3%, and around 90%, as it says here, according to Redfin, of homeowners had rates below 6%. And so that really forced people to stay put. Some other important stats or information that I thought would be interesting here as this shapes up, from a 2023 perspective, is that, new construction fell as builders were left, stuck with inflated inventory. So, the idea that builders were just going to go out and, start, putting up new homes because the demand was there was not necessarily there. One of the other contributing factors to that, not only was it the interest rates and all of those things, but if you also look at the cost of materials, things like steel, other materials to lumber, the pandemic had a very negative effect on the production of those materials, which also drove up construction costs, and that had a negative impact on development overall as well. When it comes to home sales fell more than 18%, in 2023. That was hitting some record lows. The median days on the market soared beyond 1 month as things kind of cooled down. The median days excuse me, the investor purchases dropped at a record rate as well as a result of all of those factors that we're talking about here. So just a lot of interesting dynamics that were going on in the single family market, as it relates to 2023. And when we look to 2024, what I want to point out for folks is really from as it relates specifically to the multifamily space. In a second, I want to help you understand that, there, according to CBRE for this research, there is an increased chance that the U.S. Will avoid a recession and achieve what's a soft economic landing in 2024. So, but what is also being suggested is that economic growth will slow, and downside risks are elevated. So what this is really saying is that, the essentially all of the talks or the threats of a recession, and all the threats of interest rates, potentially, and the rate hikes that we were going through in the economy, and where would things stand, the volatility that exists out there. Really, most economists are saying, many economists are saying, we may have avoided the worst of it. And that's something that's really interesting, from this perspective. From a commercial real estate perspective, investment activity is likely will begin to pick up in the second half of 2024. I thought that was interesting, but then also some of the other dynamics. I think what's really interesting about this, if you bring some of this information and just into your own lives as consumers and people that are out there in the marketplace, think about things like, the hybrid working arrangements, and how hybrid working arrangements have impacted, the growth, or lack thereof, in office demand. If it was just a few years ago where WeWork was the thing of the future, and then, the pandemic hit, and things and WeWork essentially that business model was really challenged. And then if you look at other commercial office space around places, and anyone can drive around and see that things aren't the way that they were before the pandemic. There is a lot of vacancy. There are a lot of folks looking to lease out spaces, but it's just not there. But on the retail side of things, that it seems as though some of the retail fundamentals are expected to remain strong, and this is due to a scarcity of new construction. A lot of developers were, may have backed off from that, and of course, where certain retail it makes sense, they will, you'll see certain developments come up, but for the most part, you're not seeing a lot of new construction deliveries on retail, just based off of the fact that people are being wary and thoughtful about where and when and how they pull up retail developments. When it comes to the industrial market, one of the things that I thought was really interesting is that this is expected to remain healthy. Other aspects of, when we think about industrial, think about the warehouses, think about, essentially getting your Amazon packages to your doorstep faster. Though there's a lot of demand for those distribution centers and other facilities to be able to move things throughout the country faster, and that demand continues to remain strong. When it comes to apartments in particular, and we'll drill down on this in just a moment, there was a big wave of new supply in apartments in decades, essentially. And this is expected to temper some rent growth in some markets and improve affordability for some renters. But really, the dynamics there are quite interesting because, yes, while rent growth may slow a little bit, the demand is still high, and supply, albeit there is some supply that's there, it's still not meeting the demand that's there. So it will be interesting to see some of the exponential growth that we've seen over the past few years in terms of rent growth may not be the same in this year going forward, at least, but you can still expect rent growth and substantial rent growth nonetheless. But we'll see where that levels out at. Hotels and that industry, of course, continues to face some headwinds according to the research here. And then finally, data centers. Think about all the computing and cloud services and all of the things that we all enjoy on a daily basis. These types of facilities are huge investments and are providing a lot of opportunity. In that sector of the commercial real estate market also looks really strong. But we're here to drill down a little bit on the U.S. multifamily real estate market outlook, and I want to hit on a couple of key facts here. So the 2024 multifamily outlook, it looks strong. And the primary reason for this is because the cost to buy is substantially higher than the cost to rent in most markets. And so according to some experts, specifically one of the sources that I use for much of my research, is the Visual Capitalist, for example. Home prices spiked as millennials entered their prime home buying age during a period of ultra low mortgage rates, right? And the federal funds rate, the Fed, they increased interest rates 11 times to slow the inflation over the past few years that we all experienced, as we were just talking about. And that had an effect on increasing the cost of home ownership. And according to Redfin and to other sources, CBS News and CBRE, as some of the sources that I utilize for this research, the data shows that essentially in the U.S. Costs, the typical home in the U.S. Costs 25% more to buy than to rent. And then if you look at it from another angle, it's 52% more expensive to buy a home than it is to rent an apartment. And I want to say that again because I want that message to stick, and that's one of the key factors that we're going to drill down on here in terms of why apartment investing makes sense. And that is, again, there is a 52% difference between the cost to buy and the cost to rent. And so it has never been this high before. And when we think about it and you look at the research even further, this does not include insurance, maintenance, repairs, and other cost of home ownerships, which I know for those homeowners out there, you are all very well familiar of all the other costs that come with owning a home. And so what makes renting attractive from apartment investing perspective as well. So the biggest wave of new supply, as I mentioned earlier, in decades, according to CBRE, is expected to come some in 2024, and that supply is in theory should bring about more affordability for renters this year. The average rent growth of 1.2% is expected on average across the various markets. And so, despite near-term economic weaknesses and vacancy rates, this essentially will rise further above the pre-pandemic averages in 2024, and enough demand should keep average occupancy rates, the how full these apartment complexes are, it should keep them above about 94%. And so many developers, have really started to focus on key markets to support the supply that's there. And some of those markets that are out there that I'm sure many of you have heard of, think about Austin, Texas, Dallas, Texas, Houston, Texas, Nashville, Atlanta. These are the places where they have the highest job growth projection, and therefore the developers know these data also, and so therefore they want to be able to bring supply to where the demand is. Again, but there's still not enough supply to meet that demand. And one of the other things that I talked about, just to continue to build on the message the lack of supply, is that, from a multifamily perspective, multifamily real estate is playing an even more important role in alleviating some of the severe housing shortages. And in some, by some estimates, it is known or spoken to be about 3 to 5 million housing units short of single family homes that is contributing to home ownership challenges. And that is driven by some of the factors that we talked about earlier, everything from the lack of development to high interest rates and other things that are making it very difficult for those folks who wanted to be home buyers. But as I mentioned to you before, the cost of acquiring a home is out of reach for them. And drilling down on that more, the premium for average monthly mortgage payment for new purchase homes versus the average rent, as I mentioned before, this is looking at a big gap. It remains above 35% versus 52% in 2023. And so some of the markets that are being focused on, when you look at the mountain markets or Sunbelt markets, these regions are expected to continue to have, some negative rent growth through mid 2024. But this will attract more renters when they think they can get a deal in these markets, and that demand again will continue to allow for rents to keep pace with the demand and with the inflation. So when we think about investing with a longer time horizon, it's really what's important to know are the fundamentals. And some of the softer fundamentals are in higher borrowing costs that have negatively affected property values and created significant buying opportunities for investors. So there's other factors out there that folks are talking about. A lot of investors who over the past few years had invested with floating interest rate debt, and they did not get fixed interest rate loans, or maybe cannot adjust them, or and are running out of time. That also is going to create a lot of buying opportunities for investors, but with investment activity expected to remain, somewhat flat, or in this year, investors have an opportunity to consider more of a longer term investment strategy. So, this means, potentially looking at hold periods that may be a little bit longer. 5 to 7 year hold periods could mean that markets, for these assets, to, from a buying perspective, to hold them a little bit longer. But that is going to be market dependent, and that's going to be asset dependent. Different projections for different investment opportunities. But the other factor that's important to note here is, again, real estate investing is really data based, and when it comes to the markets and which and where you're investing, really focusing on landlord and business friendly environments is really important, because local regulatory environments and governments can have a really tremendous impact on the investments that are there. Essentially, factors like rent control and other policies. Think about some of the things that are happening in California and New York, or other places where the governments have a huge influence on the real estate market, may definitely play a role that can make it challenging. So you want to be mindful of those markets that you are investing in. Of course, things like climate and public safety are also really important factors to consider, for investors, and because, of course, for some of those investors who are investing in Florida, or on coastal Florida in particular, you want to be mindful of those things, because those are areas where that may be susceptible to certain catastrophic events when it comes to natural disasters. So all of those things are things that factor into people's decision making, when it comes to investing. And when it comes to investing and preparing to invest, when you are armed with, all of this information, and you're getting poised and ready, as it's early in the year in 2024, and you want to be able to position yourself, for investing and going forward. And with all of this research, what are some of the ways that you can invest, and why is it important, for you to be investing anyway? And one of the things that I like to communicate to help people understand is that real investing in real estate, for those who are, primarily or exclusively investing in other asset classes, like the stock market, through your 401k, through your IRA, through mutual funds, ETFs, or maybe you're trading, you're playing in crypto or something along those lines. Or maybe you're just thinking, hey, I'm just going to leave my money in a savings account, and wait until things get better. Well, I really want to make sure that people are armed with this information, because it's important to think about this from a diversification standpoint. And some of the factors that make diversification, into real estate in particular, really attractive, is the fact that real estate has historically been a stable investment, and this is something that it has been tried and true, before our time, and it will be tried and true, after we are no longer here. The passive income that real estate investing provides, and passive real estate investing provides in terms of passive income, is also something that's really attractive. Looking to create those additional income streams is something that's critically important. For those of you who are working professionals, who are, thriving in your careers, or maybe your students or other things, looking at opportunities that to invest and take advantage of real estate, but not have to be hands-on, and you can be hands-off, are things that you may want to consider, because you can then leverage the skills and expertise of professional investors and operators, and then you can invest alongside of them to be able to help you successfully scale your portfolio. The tax benefits, one of the famous investors that we all know and have heard of, Warren Buffett, talks not only about, the money that you make, but it's not so much about that, but it's more about It could be more about the money that you keep. And when you think about the investments, you want to be looking at investments where it's helping you keep more of the money that you're earning through your investments and not losing it away in the form of taxes to the government. When we think about appreciation, you want to be able to take advantage of assets that appreciate in value, that you can utilize that build up that equity to be able to, essentially take that equity and buy other assets. Those are important things. You want to be able to hedge against inflation. What do I mean by that? When as inflation increases year over year, you want your rents, in this case of your properties, to be able to keep pace with inflation, or in some cases exceed that number, so that your dollar is keeping pace with that, all while you're an owner in an asset with a fixed interest rate, where the mortgage is being paid down by your residents, and then the purchase power of that dollar is being eroded away. That's a magical thing to really help increase the value of those assets. You want to be able to have control. So a lot of folks think about, hey, if I'm going to invest in real estate, I'll just go ahead and invest in a REIT. But REITs and syndications and funds are not the same. Unlike REITs or crowdfunding platforms, investors can choose which specific properties they want to invest in when it comes to a syndication or a fund. And so or a fund of funds, I should be more specific. You are able to come into an asset and invest in something, whereas in a REIT, you don't have that control of those things. And then, of course, you get a chance to leverage, the power of leverage, not only leveraging, the influence and the power and the skill set of the operators that you're investing with, but you're also able to take advantage of leverage as it relates to the pooling of your funds with other investors to buy larger assets, and the leverage of that you're utilizing from the bank to be able to acquire an asset, and control 100% of it as a result of that. These are really things that are putting these types of investments in your favor. Want to make sure that I talk a little bit more about, so how do you go ahead and you fund your real estate and syndication or fund opportunities? It's really important to understand, many people are thinking about, how do I position myself and make myself ready for these opportunities that may come up in 2024. I want to be ready to be able to invest. And there are many different ways to invest. And this is not an exhaustive list by any means, but these are some of the ways that I have invested, or and that I want to make sure that I can share, some of the strategies and that I've used to invest with others that have that maybe are thinking about investing or exploring different investment opportunities. And then think the ability to share that information, just to put ideas in people's heads, to be able to allow them to research and come to the conclusion themselves, is something that was so important. It's almost like that gateway. One of the common ways, of course, that people look at investing is cash. And so when it comes to cash, people are looking at multifamily investments that, because they provide that natural hedge against inflation through the rental increases. So you invest in an asset, and as inflation increases along with the cost of the goods and services that we talked about earlier, as strong demand, from an apartment owner perspective, we are able to increase the rents to keep pace with that inflation, all while the property is appreciating in value. And so for those of you who are heavy cash holders, who say, hey, I'm just going to keep my money in a savings account somewhere, consider the fact that, if inflation on your money that is in a savings account is in fact losing purchasing power every day that it's in that savings account. Your savings account, even if you have some fancy CD out there, is not keeping pace today with today's inflation rates. And so the value of your dollar is less today than it is than it than it was yesterday, and it will continue to go on that way. And so, thinking about how do you make your money work for you, and how do you make and so that you can continue to grow your portfolio is something to consider. And so many folks invest into these types of things, into these types of investments like syndications and funds with liquid cash. Another way that people look at are investing is they looking at an arbitrage play. And again, this is all dependent upon the market and in the space here. But essentially, I talked a lot about how over the past few years since the pandemic, home prices and have appreciated substantially in value. I'm sure many of you watching now, and those of you who will be watching on the recording, know or are experiencing yourself a tremendous equity buildup in your own home or homes, plural. And that home equity loan or home equity line of credit, the proceeds, for many people, find that money and they're like, oh, I have a home equity. I have 300,000, 400,000, $500,000 of equity, in my home. Many people go out and they'll go and buy liabilities. They'll go and buy that boat that they wanted to have, or that fancy car, or some vacation home that they don't want, they're not going to use for anyone else. It's going to just be used for them and their family. And they've created another cost for themselves. But other savvy investors and wealthy investors, they look at the home equity as an opportunity to create other assets. And what I mean by that is they're looking at the opportunity to create, to utilize that home equity to acquire other assets that create cash flow and appreciate in value and create tax benefits to be able to continue to build out their real estate portfolio in the case that we're talking about here. But of course, there are a lot of variables to be mindful of here. First and foremost, if you go through this, these are some of the situations that you'll want to pay attention to. But the objective here is really to borrow, from that home equity line of credit at a rate that's lower than your monthly cash on cash return. So if you borrow at a 4% and your cash on return is at an 8%, that delta between the 8 and 4 is 4, and that cash flow that you receive on a monthly basis is used to return, to pay back the loan that you have on your home equity line of credit. And then once the loan is paid off, all of the cash flows are yours, and you can invest that HELOC into another cash flowing asset. But as I mentioned, there are a lot of variables that are at play here. For example, HELOCs are tied to the prime rate. So as the Fed increases interest rates, the interest on that loan increases as well. And that's something that you want to be mindful of, to be able to manage those things. And of course, for those folks who had refinanced during the pandemic from that 6, 7, 8% mortgage rate down to a 3% or 4%, there might be some likelihood that may have an impact on your home equity, or excuse me, your mortgage rate. So all things to be mindful of, but a strategy nonetheless for you to consider. Another important way that I like to educate folks on is about the fact that many people don't know this, but they can invest their retirement funds into real estate investing. Really, there's two common ways that people do this. There are self-directed IRAs and there are solo 401ks, or specifically in my case, EQRPs. In the case of self-directed IRA investing, the self-directed IRAs allow you to essentially own alternative assets like real estate, and they also allow you to, just like any other investment that your IRA would be in from a retirement planning account, whether it's invested in some mutual fund or some other asset, It's all tax-free or tax-deferred growth within your account, and the investments are protected. But one of the things that people aren't aware of until it's too late, some in many cases, is that when it comes to IRA investing, unrelated to it, there's something called UBIT, or unrelated debt financed income, or unrelated business income tax. And when it comes to these types of things, this could have this UBIT tax could really have a negative impact on your investment. And so, this could eliminate or negatively impact your returns, is the summary of what this is. And then also, one of the things that exists when you have a self-directed IRA, there is oftentimes a third-party custodian that essentially you have to get approval from in order to make investments. Now, oftentimes this will vary and people don't have any issues, but know that there are other hurdles to go through or to consider when it comes to investing with a self-directed IRA. When it comes to the EQRP, solo 401k, and in fact, I am a user of this, and this is something that I speak to directly from experience, as well as many of the other ways that I'm sharing with you tonight. The checkbook control of your retirement accounts. It allows you to invest in various different alternative assets, not just real estate, but precious metals and other opportunities for those of you who are considering doing private lending or micro loans. You can do those types of things. It also has one of the great things that people don't know, similar to your IRA, but also for your 401k, for those of you who had worked at other companies before, and you have decided to leave that company for whatever reason and go to another company to work for, but you had your 401k. It's out there sitting with Vanguard or Fidelity, but you didn't roll it over into your new company's 401k yet, or you did, and there may be an opportunity for you to unlock those funds and put them into a self-directed IRA or solo 401k, so that you can then have checkbook control of what you want to invest in. You don't have to just roll those funds into your new company's sponsored plan. You can take that your own money that you've earned, invest it into assets that you believe in and that you want to diversify yourself from the market. So something to consider there. Other factors that exist there, I believe the IRA has something similar. You can take personal loans from your solo 401k, and then also when you can define the terms, the payment period that you pay it back, as well as in some cases, you won't be able to define the interest rate, but you can define the terms in terms of payback period. And what's important about this is that it's UBIT exempt, and so that tax that exists on the IRA does not exist for the solo 401k. Cash value life insurance. So this is something also that many people don't know, but cash value life insurance is a very is something that many wealthy folks have utilized for many years to be able to invest. What's really attractive, one of the things that I learned about this in particular, is, and this is another strategy that I use, but so people like Walt Disney, for example, one of the ways that Walt Disney was started is that he took a policy loan from his insurance policy to be able to help start Walt Disney. And the way that cash value life insurance works essentially is that it encompasses multiple types of life insurance that contain what's called the cash value. This cash value component typically earns interest that's uninterrupted or over other investments, and it gains and it grows tax deferred. The term, term life insurance, which many of you are familiar with, term life insurance does not have any cash value. A whole life insurance policy is considered the basic insurance, and policy premiums are for the life. But what's important about this is that when you can invest in real estate by taking a policy loan from your cash value life insurance, and while the cash value is growing and compounding interest month over month, what you can take a policy loan from and not interrupt the compound growth of your cash value because you're taking a policy loan from the insurance company, using that money and borrowing it at a rate at an attractive rate to then invest in another asset that is going to pay you cash flow, appreciate in value. And again, similar to the HELOC, you are looking to be able to invest in an asset that has a higher return than the rate that you're borrowing, so that you can take advantage of the arbitrage between the two. And this is, once that policy loan is paid back, you can then rinse and repeat that process and begin to acquire other assets with that cash value. So it's really something that another strategy that again, a little bit more advanced, but something for folks to consider. But what's important about the life insurance policy is not only do you have the cash value, of course, that's important, but what's more important, or equally as important, is that you are protecting your human life value. And so you having that life insurance policy protects you, protects your family. In the event of your demise, that life insurance policy will take care of your family and your legacy through that policy. And the other asset that it provides, and the cash value that it's able to build up with all the tax advantages, that's additional benefit. But these are things that you can definitely take advantage of and learn more about. But I just wanted to share a few of those notes with you. So in bringing it home and from a summary perspective, the U.S. single-family housing market will continue to be out of reach for many home buyers seeking their first home or their next home. So, as I mentioned before, there is a 52% gap between the cost of home ownership and the cost of renting a home. And as a result of that, this is driven by home prices, high interest rate, low supply and high demand that's creating this environment, and there's no real end in sight to when it will be able to be resolved. And as a result of this, the U.S. commercial multifamily real estate market, remains a strong investment play, and because this is an avenue for providing clean, safe, affordable housing in places where there's strong population growth, job growth, and the demand for housing. And investment portfolio diversification into assets that are backed by real estate can be a wise strategy for many people to consider, to minimize downsizing. A lot of people have talked about the gains that the stock market has had over the past, maybe, in December or so. And but if you think about what the losses that took place in 2022, when on average it was reported by many news outlets that the market lost, average Americans lost about 22 to 25% of their wealth in the volatility of the market. If you think about that, the only thing that has taken place from 2022 through 2023 is that the gains that people lost may have been recovered in some cases, but not for everyone. So this is something to think about. And so when you're thinking about minimizing your downside and not being entirely exposed to the volatility of the market, and investing in real assets that provide the benefits that I talked about earlier, These are things to really be considered as savvy investors. There are multiple options for accessing capital, as I just mentioned to you, just a few moments ago. This will allow you to deploy it into well-bought real estate assets and to take advantage of joining investor clubs, gaining access to different communities, so that you're able to be aware of investment opportunities that are becoming available, that may align with your interest, and you can go ahead and take advantage of those things. So for those of you who are interested in learning more, and if this sounds like something that is of interest to you, this is by no means a sales pitch, but like I said, I like to talk about people. I'd love to offer you a complimentary call to talk a little bit more about that. And if it's something that sounds like it could be a fit for you, I'd love to be able to offer you an invitation to join our investor club. And essentially, for our investor club, joining our investor club just simply means that you'll be on our list to receive, helpful information about multifamily investing, similar to what I shared this evening. I send out, whether that's emails, you'll be a part of as a part of our meetup, you will join our community and be able to have information that gets out there, where we invite expert guests and speakers to come and share helpful information. And it also puts you on the list to receive investment opportunities, to learn about what types of things that we might be having available at that point in time. And so really appreciate everyone joining us this evening. As I mentioned, the key sources that I use this evening for my research that I shared with you were both from Redfin. And Redfin, many of you maybe even have the app on your phone. This is a corporation that focus on residential real estate, and CBRE, which is the world's largest commercial real estate services and investment company. These are the two major resources that I use for tonight's research, and happy to share with you. But I really thank you all for taking the time to listen, to learn tonight, and I'll go ahead and stop now for any questions that you may have. Aubrey, you have your hand up.
Hi, can you hear me okay?
Yes.
Hi, yeah, I just had a quick question on the cash value life insurance slide.
Y- yeah, sure.
Um, sure, yeah. So you mentioned you invest in some of them, or you have some of them. Can you provide some examples of which ones is recommended, or not necessarily recommended, but of which ones are good um for the investment strategy?
Yes, so it's a great question. And what I would tell you is I'd be happy, well, first and foremost, just to address your question directly. Many of when we talk about investing, utilizing cash value life insurance, these are really specifically designed, policies. They're structured in an appropriate way to maximize the cash value, and also maximize the death benefit, and keeping it all in a cost effective way for you to maintain the policy. What's really important around this is that when we talk about the importance of how it's structured, is that an incorrectly structured life insurance policy could be structured in what's called a MEC, or a modified endowment. And if that happens, the government looks out for those things, because it could essentially it could just become a haven for people to just pour money into and avoid paying tax on that money, and the government wants to control against that. And so what I would tell you is that I definitely have contacts that I would be happy to put you in contact with, in terms of the companies that we've looked at and we've used to be able to get our policies created. And if you would like, you can reach out to me separately, and I'll provide you with that information. I'll be happy to share.
Okay, that sounds really good. Thank you so much, Chris.
You got it. What other questions does anyone have?
Chris, I've got a question. I saw somewhere in the PowerPoint It said that market selection and underwriting have become more complicated as we move into 2024. Why is that?
Yes, because market selection and market cycles have become more complicated because of some other variables that have come up. So, like we talked about, take for example, Florida. Florida is an extremely attractive market if you look at it just purely based on numbers. There is a significant amount of job Florida, especially in some of the coastal areas. Insurance has become extremely expensive or has become unattainable. And the reason why is because of the recent natural disasters that have taken place have really made it so that insurance companies aren't necessarily interested in those things. So many investors that are looking at those opportunities where they're seeing great economics for some of these deals, but those economics are changed dramatically once the insurance costs are factored in, and how would they be able to manage that and keep the asset stable? Look, there are many investors that are successfully investing in Florida. And so that's why it's so important to be able to tap into those people who have substantial expertise and knowledge and know-how about those markets so that you can tap into that as well. And then that way that'll help you think about things that you may not have considered. But that's just one example around what's making these things a little bit more challenging.
Interesting. That makes a lot of sense. Insurance and whatnot could eat into a property's cash flow and all those unexpected
Absolutely.
factors.
Absolutely. What other questions do anyone have? I know that I went just a couple minutes over, so I was trying to hustle through it there and make sure that I can hit on some of the major points. But what I'll do now is I'll wrap up, and then I'll stop the recording, and we'll go ahead, and anyone that wants to stay back and have any other questions, I'm happy to take them on. But before I sign off, I just want to thank everybody for taking the time out this evening to come and to learn about the 2024. From my perspective, U.S. multifamily market overview and some strategies for investing. I hope I, really put some ideas in your head to consider. Probably like we were talking about, anyone else that's out there. You can reach me at chris@redfoxmultifamily.com. You can shoot me an email. Happy to share more information and just chop it up with you to get to know you a little bit better. I really thank you all for taking the time out for joining, and I look forward to seeing you at future events. We're going to have our next event in February, and then we have several speakers lined up for the next few months here. And so stay tuned for the latest announcements on those things. But I look forward to seeing everybody in future events, and really looking forward to everybody having a great 2024. And thank you very much for joining. So I'll sign off from here.
Thanks, Chris. Thank you.
Thank you.
Thanks, Chris.